Okay, let's go.
You map out the perfect daily directional bias and enter the market, only to watch a rapid price drop trigger your stop loss. Minutes later, the market reverses and executes your exact macro thesis, leaving you on the sidelines. Daily expansion represents the aggregate result of lower timeframe shifts. It is a byproduct of structural transitions that occur well below the macro horizon. In this sequence, early buyers are systematically swept by an opposing wick before the trend resumes its macro trajectory. This aggressive wick indicates timeframe misalignment. Intermediate currents move against the primary flow, creating volatility that must resolve before expansion begins. Predicting the daily direction does not guarantee a profitable outcome. Survivability in these cycles depends on a trader's ability to navigate the lower timeframe validation process. 4H profiling provides a mechanical framework for identifying the specific window where this volatility concludes. The daily, 4-hour, and 1-hour timeframes operate like independent currents in a river. Conflict between these vectors produces deep retracements and deceptive wicks, characterizing high-risk entries. Directional flow becomes efficient once the 1-hour and 4-hour vectors snap into parallel alignment with the daily bias. The protocol requires waiting for the specific point of synchronization before committing capital to a trade. Market expansion occurs when intermediate timeframes lock into sync with the macro directional flow. The profiling architecture begins at the daily open, specifically at 1800 UTC. Dissolving the daily OHLC candle into 6 sequential 4-hour subcomponents reveals the structural stages of the day. The first step is identifying the structural key levels, such as fair value gaps or swing highs, situated nearest to this 1800 UTC opening price. We categorize this internal sequence as Candle 1, Candle 2, and Candle 3. The primary test occurs as the C2 candle interacts with the pre-identified key level established at the session open. If C2 taps the level but closes outside the body of C1, the expansion profile is invalidated. This signifies a lack of immediate structural support. The closing relationship between C1 and C2 serves as the primary filter for determining if a session will expand or consolidate. The execution trigger for a C3 expansion develops during the final closing hours of the C2 candle. On the 1-hour or 30-minute chart, C2 must print a valid V-shaped swing point before it closes. In the absence of this internal swing point, the subsequent C3 candle typically manipulates the structure by sweeping C2's low. We must also account for the physical size of the wicks relative to the expansion we anticipate. A 4-hour candle that requires an unexpectedly oversized opposing wick to initiate its move violates the expansion signature. In this scenario, we wait for a fresh 4-hour open to establish a cleaner profile. Lower timeframe validation provides the necessary proof of intent. Without it, the risk of a higher timeframe move failing is high. The market transitions between the Asia, London, and New York sessions through the GXT matrix. In a continuation sequence, price expands immediately from the open, validating a lower key level. A reversal sequence sweeps liquidity aggressively, forcing C3 into a sudden directional shift. An aligned sequence features immediate expansion, then a mid-cycle swing point supporting the macro trend. Identifying the active GXT state allows a trader to distinguish between manipulation phases and genuine expansion windows. This matrix provides a structural framework for navigating session transitions and unpredictable volatility. SMT divergence provides the final layer of validation required before executing a 4-hour setup. This involves cross-referencing the C2 manipulation phase across 2 correlated assets, such as the US 100 and the US 30. We look for one asset to sweep a structural low, while its peer respects a fair value gap. This failure to break lower confirms the strength of the internal swing point. This divergence signals the conclusion of consolidation, triggering the C3 expansion. Institutional positioning generates these observable deviations between correlated assets. Comparing charts reveals the true underlying intent of the move. Targeting logic relies on the draw on liquidity, focusing on structural milestones like previous day or week highs. A healthy trade displays an expansion signature, rapid vertical pushes followed by shallow retracements. Deep structural breaks occurring on the approach indicate that timeframes are decoupling. When timeframes decouple, the 4-hour profile is compromised. The trade should be managed or closed regardless of the initial daily bias. Consistent results depend on the 4-hour and 1-hour fractals interlocking with precision. Professional trading requires verifying the micro-alignments that construct the macro path.